Okay guys, welcome to this live stream. This is the continuation of the first video that I upload like 2 weeks ago about we're gonna pass a FTMO challenge together. Yes, it took me 2 weeks to continue with this challenge because I was traveling, I got sick, and if I'm not in my 100%, I'd rather not to trade. So okay, we have the account. It's a $10,000 account. So the idea is to pass the first challenge, the first phase of the challenge, which is we have to make a 10% of profit without losing any more than 5% on any day or 10% of the account. It means we cannot go lower than $9,000. Okay. So every Sunday, I know today is Monday, but every Sunday on the afternoon night before starting the week, what I do is to analyze the list of pair of currencies that I have, and on each one of the currencies, each pair, if you can see here, I have the whole list here. It's a big list, and the reason of that is because from that list, not most of the pair of currencies we're not gonna be trading on them during the week, because we have a list, we have a conditions in order to open any trade. Before opening any trade, we have to make sure that we have some confluences, that we have a plan, and that we follow the plan. First thing that we need to understand to be able to pass this challenge is that you have to have a plan. If you don't have a plan, you are just gambling, and if you are gambling, well, this probably is not for you. You have to take trading, your trading account, like a business, not like a gambling or entertainment thing. So yeah, first thing is that you have to have a plan. In case that you don't have a plan, just follow this live stream or this series of videos that we're gonna make in order to pass the challenge. If we lose the challenge, is fine as well. That's another thing that you have to understand, is that like any other business, you can have good trades, bad trades, and at the end of the day, losing a trade is going to be a constant. You never stop losing. The only difference is that over time you lose properly, like a professional. Is the only thing that is in our hands. At the end of the day, we do nothing to make the money. At the end of the day, you are just opening a trade, and after that the market decides. If it goes up, you make money. If it goes down, you lose money. So you don't move the market, to be honest. Nobody moves the market, not even with $1 million account. It's able to move the market. Market is moved for big sharks, big companies with lots of money. So always remember that our duty is not to make money, because the money, it makes itself. Our duty is to lose professional. And what does it mean to lose professional? To lose professional is that you respect the rules that you have. For example, if you say you're not going to lose more than 1% for every trade that you take, so you shouldn't be losing more than 1% of that. If you lose 1.5, you lose 0.5% that you shouldn't have. And that's the kind of professionalism that you want in this kind of business. So just to clarify, guys, let me show you here. I'm gonna write down here the conditions of the challenge. So it's two phases. Phase one, we have to make 10% of the count. Oh, sorry, guys. Have to make 10% on profit. Conditions: we can lose more than 5% per day, any given day, and we cannot lose day, and we can't lose more than 10% of the count overall. So that's phase one. On the phase two, we have to make only half of the target, which is we have to make 5%, and the condition is the same, exactly the same. We cannot lose more than 5% any given day, or more than 10% of the count. So technically in theory, second phase is easier than the phase one, but trust me, sometimes happens that you pass phase one and you lose phase two. Okay, so this is the condition of the challenge. Some rules that we're gonna have is that we are not gonna lose more than 1% in any trade, and we have to follow the plan. We have to follow the plan to open any trade. I will share with you guys later what's the plan that we have, and what else. We have to follow the plan. Okay, not like we don't want to open trades if we are not in the laptop or computer, in front of the charts. Just as a reminder, we use TradingView, which is this software that you are looking right now, to analyze the market, but we take the trades with the phone. So I don't know if you can see here. Let me show you. Let me try to show you here. I hope you can see it, but this is the account. As you can see, it's $10,000. It's brand new, no trades, nothing. If you check on the history, there's nothing there. I really hope you are seeing this. So yeah, we haven't taken any trade, and we have to follow the plan. That's a mandatory thing. We're not gonna take trades if we are not in front of the computer, because we need to analyze the market and we need to wait for all the confluences to happen in order to take a trade. Okay, one thing that I want to remind you guys is that there's not such a thing like a golden strategy or like a never fail strategy. All the strategies have some advantages and some disadvantages. It's more up to the trader than the strategy per se, but there's no such a thing like 100% accuracy rate on a strategy. There's no such a thing. Losing is a constant. The first thing you need to understand is that we're gonna lose. At some point we're gonna lose 1 trade, 2 trades, 3 trades, 4 trades, 5 trades, whatever. But the important thing is that we make more money than when we win than when we lose. That's the only thing we need to be profitable. Okay, so taking that into account, if one day maybe I have an opportunity to take a trade, but I'm not in front of the computer and I cannot maybe take a video or record it or something, I just simply don't take the trade, because I want you to take, if possible, the same trades that I'm taking. I'll be sharing every single step of this journey. But more than the results on every single trade, the idea is that with this playlist or with this series of videos, the most important thing is you understand what's behind of every trade, what it takes to take a trade. It has to happen many things to take a trade. Many people is so worried about, what's the entry? Literally, the entry is one of the if not the last thing to worry about. It has to happen many things before you start thinking about the entry. So what other rules? I think at the moment these are the basic rules. Remember something, this is not the plan, this is not the trading plan, this is just simple rules that we have to respect in order to pass the challenge. Okay, at the end of the day, guys, remember, the market do whatever it wants. The idea of having a strategy of a plan is that you have seen something happening for so many times, so long, that when you identify that pattern on the charts, you have an idea that, okay, from the last 10 times that I've seen this, 8 times out of 10 this have happened or this have happened, and that's part of the strategy, but you have to follow the plan. Sometimes you have 5 confluences or 7 confluences that you have to respect in order to take an entry, and maybe you don't have 7, you have 3, or you have 2, or you have 4. It's up to you if you decide to take the trade, but at the end of the day, you want to put all the odds on your favor. Okay, you want to put the odds on your favor, and the best way to do that is to wait for the best confluences to happen. The most confluences that you can gather, the most confluences that you can have, the more chances you have to win that trade. Okay, another rule is that same thing, that we're not gonna lose any more than 1% in any trade. Okay, in here I have to specify, we're not going to lose more than 1% in any trade from original capital. It means that from 10,000 down, if we lose, we're going to lose 1% or less. If we reach, for example, if we have lost half of the money that we are allowed to lose, 5%, then we can reduce the risk from 1% to 0.5 in order to have, again, 10 chances to burn the account before burning the account. Now, if we are making money, if we are above the $10,000, maybe we start raising the risk to 1 to 1.5, from 1 to 1.5, and later maybe to 1.5 to 2. Okay, but we only do that if we are already on profit. Okay, what I want to clarify with that is that if we raise the risk, is only because we already have profit. So we are risking the profit that we already have to make a bigger profit, but we're not risking original capital. Okay, we cannot risk original capital. Okay, so based on that, we will take trades, or we will be looking for a 2-to-1 ratio always. This is another important thing, guys. Sometimes we have a setup. We have to face 2 challenges here. The first one is to be too scared to trade, which the solution for that, to avoid to be scared, is to have a plan. If you have a plan, even if you lose, you're gonna feel like relief, because you are doing the things according to the plan. If you have a trade that is matching all the conditions of your plan, don't hesitate, just take the trade, okay? Because you're following the plan. That's the important thing. We can have all the confluences in the best scenario possible to take a trade. We can take the trade and still have a negative trade. We can lose that trade because there is no such a strategy like is 100% accuracy rate. So first thing, that be friend to lose, be comfortable to lose, to have losing trades. You know, as long as you lose professionally, as long as you didn't take a trade without that it wasn't based on the plan, you should be fine. Okay. And the second thing is the other risk, or the other problem that some traders have. One is fear, and one is what was the word? Well, when you want to get more money than you should, you're never happy with the money. Greedy, when you get greedy. We don't want to be fear, we don't want to be greedy, okay? So that's why I put we always gonna have a 2-to-1 winning ratio. It means that if we are risking 1%, we always gonna take our money in 2%. If we're risking 1.5, we always gonna take our money in 3%. Okay? We're always gonna take our money on the double the risk that we are risking. Okay? Even though when the trade might show you that it has a big possibility to continue in that direction, so you can make a 3 to 1, 4 to 1, 5 to 1. But we're gonna do it in this case like that, just to guarantee that we can get more money faster. You know, like, we don't want to be greedy trying to guess, oh, this is gonna be a 4 to 1 winning trade. No, we don't want to guess anything. We just have to follow the plan. If we risk 1, we win 2. If we risk 0.5, we win 1. If we risk 1.5, we win 3. If we risk 2, we win 4. As simple as that. What else? Well, that's it. So let me explain you. Now that you have this clear, I'm gonna just leave this here. As you can see here, I have a list of the pair of currencies that I have. So I'm gonna explain you what I do on Sundays. So the first thing that you need to understand is that first condition of the plan. So let me put you just next here. This is now talking about the plan of trading. So the first condition is that the weekly and the daily, let's put it like that, weekly and daily time frame needs to be synchronized. What does it mean? It means that if weekly is bullish, daily needs to be bullish. If weekly is bearish, daily needs to be bearish. So that's the first condition, guys. The first condition is weekly and daily time frame needs to be synchronized. If weekly is going bullish and daily is going bearish, I don't care about that pair of currencies, at least during that week. Or if maybe during the week the daily changed to bullish, to the same condition than the weekly, maybe we can consider it, but it's not common. Normally when I check on Sundays what kind of pairs I'm gonna check, what pairs of currencies I'm gonna trade, of possible trade, if the weekly and the daily are not synchronized before the beginning of the week, I simply don't take trades on that, because it takes time, it takes days for swapping to make a break of structure. So normally, as you can see here, I don't know, there's like probably 30 pair of currencies here. Just with this first condition, I already narrowed down to maybe from 30, I'm just keep an eye on maybe 6 or 7. So as you can see, I have a huge list, but I know that just by sorting the pair of currencies with this first condition, I'm gonna be just removing 21, 22, 23 pair of currencies because they are not matching that criteria. They are not meeting that criteria. So I need to be sure. I need to be sure that this first condition is being meeting, is matching. Otherwise, I'm not gonna be looking at you during this week. Maybe next week if you give me what I need. Guys, something that you need to understand is, even though I have maybe a 30 pair of currencies list, at the end of the week, during the week, we narrowed down that to maybe 2 or 3 possible trades to take, maybe 5. But from those 5, there's other conditions, not only these ones. From those 5, maybe we are taking 1 or 2 trades, and sometimes none. And I know some people might look at this and say, well, you are leaving so much money on the table, or so many opportunities that you are not taking. Look, everything is about to put the conditions. You want to make sure that if you are putting your money on the market, you put the conditions, not the market to put the conditions on you, but you put the conditions when to put your money. Okay? So now that we know this, as you can see here, guys, let me just move this a little bit so I can move this. Let me just... what the hell I do? Oh, wait. Oh, yeah, I love it like that. Let's leave it like, wait. I didn't know that I could put it here. I think this was very clear. I can anchor this here and then it doesn't move. Beautiful. Okay, I'm gonna anchor this one here. Wait. Okay, so remember, this is just some rules, and this is where the conditions of the trade start. This is just the rules of the challenge, and this is where we start talking about the plan, okay? The confluences that we need to wait in order to take a trade. So AUD, CAD, Australian dollar, Canadian dollar. First thing I want to show you, just to explain you something, is you can see that I have some green lines and red lines, okay? And you can see that some of them are actually thicker than the other ones. The green ones here are thinner than the red ones. So the thick line is the weekly time frame, and the thinner line is the daily time frame. Okay. So let me just explain that here. Wait, where is the text here? So let me just put some information here. I think you need to have this information. So this is general information. This is just general information about how I collect the information about how I read the market. So you can see the screen and you can understand what you are looking at. So the big line, or the fat line, is the weekly time frame, and the thin line is the daily time frame. So it's just to have some sort of graphic information. So I know that the big line is gonna be the bigger time frame, and the thin line is gonna be the smaller time frame between the weekly and the daily. So another information you have to have is red line is a bearish structure. Green line, it's a bullish structure. Okay, so now that you have that information, you can tell. Oh wait, I need that space. Wait, I'm gonna move this one here. Yeah, just like that. Okay, now that you have that information, you can tell that the big one is the red one. So it means that the red one is that the weekly is bearish, and the thin line is green. So it means that the daily is bullish. Okay, so now that you understand that, if we want to meet the first criteria, which is weekly and daily time frame needs to be synchronized, by default, what's the condition, what's the graphic information that we need to have in order to take into account that pair of currencies? What do you think? Well, the condition that we have to have, graphic information that we have to have in order to sort everything fast, is that they share the same color. Either way, both time frames, weekly and daily, are green, or both time frames, weekly and daily, are red, in order to pass the first condition. It's not the only one. We're gonna talk about all the conditions that we need to have or to meet in order to take a trade. This is the first condition. It means that if I see this Australian dollar, Canadian dollar, and I have the green one is red, the green one, the daily one is red, so it's bullish, and the weekly one is red, which is bearish, it means that they are not synchronized. And just because of that, because the information is clear, like graphically clear, I don't care about this pair of currencies during this week. I'm not gonna take any trade about this pair of currencies during this week, and that's fine. You know, at some point they're gonna be synchronized again. And well, you might be asking, how do you know one is red, one is green? Well, I do the job every Sunday. That's what I do. So in this case, if I go to the weekly time frame, it's pretty clear. You can see here, bam, bam, dun, 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 and then boom, it goes down until here, and then it hasn't even crossed. Now this is the weekly time frame, which is this is the this is the bearish market. Everything inside here is just market structure. So unless that this bar here, which is a weekly bar, so at the end of the day, if this bar closes above this point, then we will have a change of structure, and this red line will turn green because now weekly is going bullish. Does it make sense? I hope if you see this video and you don't understand this, you watch the previous videos. I have explained that in the previous videos, but I know most people understand that already. So in order to change from red to green, this bar here needs to end at the end of the week above this point. Okay, so this is the weekly. If I go to the daily is different. We have this is the point of the weekly, bam, 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 bam. It breaks above, then we go here, and it breaks here. As you can see, this have a different higher point, and it just break the point here. So when I check on the structure on the daily, of course on Sunday, yesterday, it was just until here. Now if you can see, this has been going up, so I actually can move this one here because it's starting a new day, but still it's a bullish market. You know, it's going up, different than the weekly. The weekly is still down, going down. So remember, just to clarify something before we continue, the market moves like this. Okay, the market moves like this normally. So this is just a sideways movement. If we have that, this is highs, this is a high, and this is a low. They're on the same level, so it doesn't really matter. So the market structure is composed by lows and highs. That's basic. That's the basic points on market structure. But you have to understand that before you can put a green or a red line on the weekly or the daily. If you don't understand that, you're gonna put the wrong color sometimes because you don't understand how this works. So this is the low points and the high points. We have that on the structure: low, 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 high, high, high. Now this is a sideways market. It's going sideways. It's not going up or it's not going down. Now let's put the scenario where this is going up. Okay, this is now going up. So if this is going up, wait, this is going up, this is going up, this is going up. Okay, let's leave it just like that. If this is low and this is high, what will be this one? If this was a high before, but now this high is above this high. So this will be a higher high. Always the points on the top are highs. Always the points on the bottom are lows. Remember that. So if this was a low and this is already a higher high, what is this point then? This will be a higher low. Why a higher low? Because this is a low, but this is a little bit higher than this low. You understand that? Does it make sense? This is a low, this is a low, this is a low, this is a high, this is a high, this is a high, but this low is a little bit higher than this low, so it's a higher low. And this high is a little bit higher than this high, so it's a higher high. So by default, this will be also a higher high, and by default, this one will be also a higher low. Does it make sense? It's really important that you understand that first before you can put the colors, you know? So now, in the opposite case, let's delete this one. You already know that the top positions are highs and the bottom ones are lows. So let's get back to the beginning again. But now, this time they gonna go down. So this one is going here, this one is going here, this one is going here, and this one is going here. So if I have this low, this high, and I know this point is a low, but this point is lower now than this point, so this point will be a lower low. Remember, the points on the bottom are always lows, the points on the top are always highs. And now, I know this is a high because this is a high, but this high is lower than this high. So this one is a lower high. Okay? And by default, once the market goes below this lower low and create a new point, this will be another lower low, and then this will be the lower high. Does it make sense? I hope it makes sense. And of course, now that you understand, if the market is going down, now we have the red lines. If it was the opposite, like we did before, it will be green. You understand the point of the colors now? That's the kind of graphic information that I use on Sundays. I check on every single pair on the 31 of them, maybe 35. I don't know how many are there, but I do that every single Sunday because that gives me the information that I will need in order to look for the specific trades that I want during the week. You know, if you don't do that before the market opens, before you actually start trading, you will just take in random trades, and you don't want that. That's why I do this. Now that you understand market structure and why is red or why is green, I'm gonna start showing you these letters here is just what I showed you before: daily higher low, weekly lower low because it's going down, so weekly lower low is just information that helps me, is graphic information that helps me to check the markets and remember, oh, this market is like that, so I don't care about this pair of currencies during this week because the first condition is that they are synchronized. And if they are synchronized, it means that they will be sharing the same color. Okay? It's not the case, so let's go to the next pair of currencies. Red and green, I don't care. Green and green. Okay, so this one we have that the weekly and the daily, they are synchronized. They are actually synchronized. So let's put it here. Weekly and daily are actually synchronized. Okay. So in this case, these two are synchronized. So what's the next step? The next step is to identify the best retracement in both time frames. And what is a retracement, you might ask? So let me put another example. Sorry, it was not with this one. So remember I show you we have thin, thin, and thin. This is normally how the market moves. So we have, it's a bullish market. So you know that we have here a higher low. Then here we have a higher high. Okay, so let's pretend this point is not existing yet. Now let's do it properly. We only have this thin, thin, and that's it. We only have this. We don't know how the market is going to continue. So it means that this point here, let me show you, this point here and this point here, this is the higher high, this is the higher low. This is all the information we have. This is before, this is what we check on Sundays. Where is the higher low or the higher high, or if it's going down, where is the lower high and the lower low. Okay? We don't know what's going to happen after this higher high. We don't even know that this is a higher high yet, because this could be continue like this, and then the higher high will be here, right? We don't know the end of this point. We don't know it. Only we know it until it start making a retracement. Okay? Start making a retracement, but this retracement can be here and then going up, or it can be a retracement from here to here and then going up. Yeah? Or it can be a retracement to here, to here, to here, to then going up. Or it can be a retracement that breaks completely below the higher low, and then it will be a bearish market. It wouldn't be a bullish anymore. So because we don't know that, we don't know what's going to happen after this one. We don't know if it's going to continue growing. We don't know if it's going to stop until here, or here, or here, or it's going to be like this, or it's going to break. We don't know that. The only thing that we know is that if the market is going to continue with its movement, it's going to make a retracement, and then it's going to do like this. That's simple. That's the only thing we know. It's going to be, if the market is going to continue bullish, for example, let's say it's not going to break under here, it's going to continue with its movement. At some point, it has to make a little retracement. Now, what's the ideal place to take the trade? There's so many ways to wait for this retracement, and normally, for those who use the Fibonacci structure and everything like that, what I use and what it has worked for me is that normally it reaches around the 66% of the movement and then continue, and you can gain all that movement up. And what's the 66% is basically 2/3 parts of the movement from the higher low to the higher high. So now I have here a Fibonacci structure. I modified this Fibonacci just because it works with my strategy. So I just divide this Fibonacci in 3. So I have this Fibonacci structure that is going from the higher low to the higher high. And now, when I told you what's the next step after this one, is to look for the retracement on each one of the time frames. It means that what we are aiming is that this price going here, and then hopefully is going to continue up. It can end up here and maybe break here, or it can continue up after here, or then go down here, whatever. But the first conditions that we want is that after we identify the third part of that Fibonacci retracement, we want to make sure that that's the area where we want to look for our trade. Let's say that the market is bullish, we want to buy, so this will be the area where we want to buy. We want to wait for the price to reach this area. Is what we call the zone area. Some people call it area of interest. I call it the zone or area of interest. So that's another, that's the second and the third condition actually. So the first condition is, if you see here, one condition. Second condition is identify the zone on each time frame. Okay, just that. Identify the zone on each time frame. Okay, before that, there's something that we have to check, is that the fact that, for example, let's check it in this one. If you can see here, the daily higher high and the weekly higher high are basically on the same point, very similar point. My point, the thing is that we're gonna find now this retracement, this 60% retracement in both time frames. So if I go to the tick area, this is the weekly. This will be, this will be in here, the zone in the weekly, right? Weekly zone. This will be the weekly zone. And then if I do the same on the daily, this will be the daily zone. So let's put it on 3. Daily zone. So what's the next condition? The next condition is not only to identify the zones on each time frame, but to see what's the distance between them. Why? Because think about this. If we are waiting for both time frames to be synchronized, I mean, they share the same market structure, bullish or bearish. If we are waiting for that to happen, the ideal will be that this zone or this retracement between those two time frames are not really far, right? Because if we take this market, for example, is here, and we get back to the zone here on the daily, and this is the zone on the daily. From this point, the market can go up here or can go down here to the zone of the weekly zone. But the distance is so big that if you decide to buy on the weekly zone, so for example, you put a buy here as example, just as a small example, you put a buy here, maybe the market is going to continue going down because it wants to reach the weekly zone. Something that you need to understand is that not always the price is going to reach the zone. That's the next condition. But my point is, the first thing that you want to understand and identify is the zone on the daily, the zone on the weekly, and create a graphic picture of the distance between them. So I put this square that is gonna show me how big is the distance between both time frames. Okay? What's the ideal scenario? That the zone that we found between the weekly and the daily, it's very narrow, very thin, because that makes the area more powerful, because it's almost the 60% retracement, 66% retracement on the same time frames, it's a stronger retracement. Okay, if we have this zone this big, we don't know if the price is gonna go here and then go here, or here up, or it's gonna break here. And you know, for the price to go here, or here is gonna be weeks or days at least. So it's gonna be a long time. It's not gonna be immediately, you know. So my point is, first, weekly and daily are actually synchronized. Identify the zone on each time frame. 3, draw, like create a graphic, identify the zone on each time frame, draw a rectangle or an area, joining or mixing, or like mixing both zones. So the daily, the weekly and daily. Okay, once we identify those zones, if they are too far, if they are huge, if they are creating this area that is huge, we don't want to take trades on that one. So if the area is huge, if the distance between both zones, let's put here this one, if the area between both zones are massive, or if the distance is huge, we forget about that pair of currencies. So look at this condition. This is a very, people might say it's a subjective condition, but I think with the experience and over time you might identify if it's huge or if it's not. So I'm gonna leave that draw here because I think it's useful in order for you to understand. So if the area is huge, we simply don't care about that trade because we want to find a narrow state. Normally what we want is that, for example, I'm gonna put the same example with here. Normally what we're gonna be aiming to find is that, let's pretend this market structure is the weekly, which is the biggest one, the bigger one, weekly market structure. So this is the weekly market structure. This is the higher low, this is the higher high, and this will be then by default the weekly zone, right? If I put that here, weekly zone. So the ideal weekly zone. Why? Because normally, as I told you before, the market is going to go up, down, and then continue up, right? So that's the market zone, the weekly zone for this market structure. So by default, what are we expecting that the daily zone is located? Where the daily zone should be located? The daily zone should be located around here. Why? Because in that way, it's more likely that the daily zone is around this area. So for example, if the weekly zone is like that and the price is here, most likely the daily zone is going to be somewhere around here, right? It doesn't matter if they are both synchronized, bullish or bearish. The daily zone is going to be around here and the distance is going to be huge. So what we want is that the price, normally the weekly zone is bigger than the daily, but not always. There's some cases where daily is wider than the weekly, and the weekly is narrower. But normally what we want is that the price for the daily structure is close to the weekly zone. So in that way, they gonna be most likely in a narrow state. So now that I explained that, let's see what's the next condition, because we already have this huge distance. I don't care. I'm gonna delay that, because even though they are synchronized, the distance between the zones are so big that I don't care about that. It's so big. I don't see an opportunity for that pair of currencies, at least on this week, during this week. Okay? So check this structure, because this applies if it's daily, weekly, 4 hours, 1 hour, whatever. Something that you need to understand is that the market structure is universal. So whatever it happens in 1 hour, you will see the same in daily, weekly, whatever. What's the difference? The bigger the time frame, the more respected is the market structure. On the lower time frames, the market structure it's broken so fast, and you don't have time sometimes to see those changes, and you take the wrong decision. You know, it's bullish, bearish, bullish, bearish, and you have to take decisions so fast that sometimes you might take the wrong decisions. On the daily, on the weekly, you have a clear idea for the whole week, and you know what you are expecting to happen and what you are waiting to see. Okay, so weekly and daily are actually synchronized. Identify the zone on each time frame. Draw an area mixing both zones, weekly and daily. If the distance between both zones is huge, we forget about the pair of currencies. Now, if the distance is not huge, but it is a narrow area, we want to keep an eye on that pair. So, okay, we understand that now we need to find a currency, a pair of currencies. Let me just I'm gonna copy this, because we're gonna paste it later in a different pair of currencies. So we already know that even though this one, Australian dollar, Japanese yen, they are synchronized, they are on the same direction, they have the same market structure, both of them are bullish. The zone, oh my gosh, I put this with a set, oh my gosh, what's wrong with me? The zone on both time frames are so far that we don't care about that. It's so huge that we don't care about that. We want a narrow state. Okay, so this one's good, I'm gonna leave that row in there. So what we need to look now is synchronized time frames, but with a narrow zone. So let's continue. This one is gonna happen the same, the same than the previous one. They have the same market structure, they are synchronized, but if this is the distance of the weekly, this is gonna be the zone. Now I delete this one, and you know that on the daily, which is the thin lines, is gonna be around here. It's huge. You see, it's huge. As I told you, the idea is that the price will be around this area. If it's around this area, they're gonna be close on the zones. So I don't care about this one. Same problem. One is gonna be around here, one is gonna be around here. It's easy to identify because of the position. One is gonna be here and one is gonna be sorry, around here. It's massive, doesn't work for that. Let me just change the color of the pen for blue. Yes, I don't want that you think it's something related with going bearish. Okay, so I don't care about this one. Okay, this is a different one. Check this one. Great confluences on this possible trade. So if I put that, it's because we saw something that we were interested on. So wait a second. Well, this continue going down. So both, let me just paste what I copied before. So as you can see here, both time frames are going down. So it's a bearish market. And I already put a zone and I put an alarm. And the alarm says weekly, daily area of interest or weekly, daily zone is the same. So I'm going to explain why. So if we go to the weekly, if we go to the weekly, the problem is that this is the movement of today. Until yesterday, it was until here. So I want you to forget that this exists for a second, because this is the activity of today. Okay, so that's why. Wait, how can I cover this? Okay, forget about this for a second, because this is the movement of this week, of Monday. This is what it has been moving on one day of the week. Today is Monday at night, so we pretty much finished the first day of the week. But what I want you to do is to wait. How can I cover this? I want you to pretend, yeah, this one. I want you to pretend this doesn't exist. 30%. Okay. Wait. Bring to the front. Okay. The market yesterday on Sunday was like that until here, because it was Sunday, the market was just opening, and on Sundays we always check the market structure on every single pair. It doesn't change so much from week to week. Normally it's just the daily ones that change, but the weekly sometimes they remain the same for a couple of weeks. But basically the market was yesterday here, so the market was pan, 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 and boom. We don't use the tails, we use the bodies. So as you can see, this was the lower high and this was the lower low. That's why we have the weekly lower high and the weekly lower low. Okay? So I'm just showing you how we set those lines. There is a reason because we have those lines. So now let me just delete this one. The big ones, the fat lines are the weekly. Now let's go to the daily. So on the daily, remember this didn't exist. This was like that. Oh wait, no, it was like this. This is Monday. Oh yeah, this was Monday, and at 4 p.m. At 4 p.m. on New York time, it creates a new bar. Okay, so this was created from Sunday 4:30 p.m. to Monday 4:30 p.m. and this is the continuation of Monday 4:30 p.m. till tomorrow 4:30 p.m. So what I want to show you is that on Sunday this didn't exist. On Sunday this was just being created, this one, so it was just here. So on the daily we have pam 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 boom. It was until here that it was created. So that's why this is the daily lower high and this was the daily lower low. When we were checking on Sunday on the market structure, the price was there. So that's where we put the points, because the lower lows and the higher lows, because the lower high, sorry, because that's where the market was. So ignore those ones, and now check what we're gonna do. We're gonna take the 60% retracement that we are expecting on the weekly, which is here. Okay, so it's the bottom of the square, and on the daily is the top of the square. Can you see? Can you see exactly that the retracement is on here for the daily, and for the weekly is just the bottom of the square? Can you see? Look, I really hope you understand what we are doing here. Now I draw the distance between those two, and I can see this is one of the thinnest areas of interest that I have seen. So I'm interested on that, on taking the trade. So what we are hoping during the week is that this market moves like pam, 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 and it reach this area here to then continue on the downside. Okay, again, the market do whatever they want. So at this moment, from Monday gone and Tuesday being created, this continue going down. What does it change? It changed nothing. It basically, what's gonna happen is that the daily is gonna change lower here, and the weekly is gonna change lower here. But because we are changing both, the area of interest is gonna be around the same area. So let me check. This is the daily. The weekly, I cannot change the weekly because the week hasn't finished yet. I can change the daily because there's one new day already gone. But on the weekly, I cannot do that until the week is gone. So if I take this one, which is the daily lower low, I can put it here. I'm not gonna put it below here because that day hasn't finished. I only have to check it on the day that has been finished. And then that most likely is gonna change this area. So let me just delete this, and we do it together so you can understand what we are doing. So this is a clear example of a daily, the daily lower high and the daily lower low are wider than the weekly. Even though the weekly is a bigger time frame, the daily is wider because they are so close and so narrow that on the weekly I cannot move this here because this hasn't finished. I hope you understand that. Look, you can see the time that is remaining for this bar to be finished. 3 days and 19 hours. I cannot change the weekly because of that. Maybe in 2 days this bar is gonna finish here and it's gonna be continue the same structure. Maybe this is gonna be delayed and it's gonna finish here, and it's gonna be the same point: weekly lower high, weekly lower low. That's why we don't change it, because it hasn't been formed completely. Different on here is that on the daily, this has been filled completely, it has been formed completely, and this one it's remaining 18 hours 51 minutes. So that's why I told you around 4 p.m. 5 p.m. the bar is finished on New York time. I'm behind 1 hour from New York, so pretty much for you to understand, 4:30 5:30 p.m. from us. Sorry about that, need to drink some water. Okay, so now that we changed the daily lower low, let's find the zones. Look, I have to change this one here as well. The zone on these ones as well. Let's find the zones. So let's go for the wider, which is the daily. This is daily. Remember, the thin one is daily. So this is the daily, And now let's check the retracement for the weekly, which is here. It's very close, very close. It's still pretty narrow. It didn't change much. It must change a little bit because the daily was moved, but it didn't change much. So this is our area. So what we're gonna do is to draw a rectangle here. It's gonna be, I always keep the opacity on 30%, and it's gonna be red because the color gives me the information if we are looking for selling or to buy. Sorry guys. So if it's red, if I have the red color, I know that this is a selling area. If it's green, I know I'm looking for a buying area. Okay, this case is selling. And what I do, because there's so many things, sometimes I'm not in the computer, but I need to know when the price reached the area. So the next step is actually that one. Condition 6, the price needs to be at the area of interest or the zone, to the zone. Let's put the zone. We don't sell, we don't buy unless the price is on the zone. I don't care about anything else. Actually, if you check here, this is a very good zone because look how many retracements and rejections have that point. Now we break it, so it's the ideal area to get back here and then continue to the downside. So my point is, if the price doesn't reach this area, I don't care. I don't care. I'm not interested on taking any single trade. Let me just extend high and left. Okay, just to put it like that so we can understand what's going on. When you extend the rectangle to the infinite, you can see that it's a very important point when there's some rejections from the past. You know, it's a really good point. So what I want to do now, what we want to do is to set an alarm here. Why? Because the price might reach that area and we are not around. We don't have the computer. We are far away, but we want to be sure that when the price arrives there, we have the notification, so we know that we have to open our laptop or computer and we have to check the market. So what I put here normally is weekly, daily, area of interest. You can put weekly area, weekly, daily, the zone, whatever. Actually, look, we can put it here as weekly, daily, area of interest, or the zone. Look, we can type information, important information here. So it's really important that you use the tools that the trading view gives you, because we are swing traders. The strategy that I'm teaching you, or the strategy that we're going to use to pass this challenge, is through swing trading, which is basically what I explained you before. We make the market analysis on Sunday and we wait during the week that this analysis happen. You know, that the trades that we are focusing on have some relevance or not. That's how we keep from a list of 35, 40 pairs of currencies. We keep an eye just on 3 or 4 during the week. And from those 3 or 4, maybe we have one trade or maybe none. So that's why Sundays is really important, because if you don't do this, you just be looking during the week, oh, what can I take, or I should put my money here, oh, this looks good, but there's no logic behind, you know. And at the end of the day, we can do all of this and still lose a trade, of course, but there is a plan, there is an order, and there is something to follow. And when you have a plan, normally if you follow the plan, this kind of things is going to happen is going to continue 7 times out of 10 within movement. So what I mean is that normally it's going to do this, it's going to check the area and normally go down. Of course, sometimes it's going to break and continue and we're going to lose money, whatever. But you want to do what happened most of the times. That's my point. Nothing happens 100% of the times, but you want to make sure that you do what happens 70% of the times, 65% of the times, 80% of the times, because that's how you make money. When you do what normally happens, and you follow that path, that's what you have to do. Okay? So price needs to be at the zone, and well, that's the thing. No price has reached the zone, so let's find maybe a new pair of currencies, one that maybe has reached the zone, because at least for this one, which is Canadian dollar and Swiss franc, until this price doesn't get here, holy cow, until the price doesn't move from here to here and activate my alarm, there's nothing to do on this pair. We found the area of interest, we found the zone, both time frames are on confluence, they are synchronized. Another confluence is that exponential moving average is on the same direction, which is going down, but we're going to talk about that later. But my point is, if this price never reached here, we have nothing to do. That's how strict we have to be with our plans, okay? With our plan, basically with our trading plan. You cannot be taking money is not make because you take more trades. That's actually the opposite. The more trades you take, the more money you might lose. The only thing you want to do is to take 1, maybe 2 trades per week, maybe no more than that, but you want to make sure they are high quality trades. If they are not high quality trades, you're just wasting your money and wasting your time. Remember, it doesn't matter if we lose, because we're going to keep losing all the time. What we want is that every single trade that we take is a high quality trade, and we only put our money in a high quality trade. Otherwise, we don't bother. Okay, so let's continue. We need to find now a pair of currency that already meet all these criteria, and that maybe the price is already on the zone. So different colors, I don't care. Same colors, huge distance, doesn't work. Look, daily is here and the weekly is all of that, doesn't work. Different color, doesn't work. Whoa, we have one here. I know that I put this is because it's the same. So you already know what this square is the zone or the area of interest. Let me just extend this left to right. Yeah. So we already know that this one, text. So weekly, daily, zone. Weekly, daily zone. So we already know what's this is the same. As you can see, I have the alarm here. Weekly, daily area of interest or weekly, daily zone is the same. So basically the same situation than the previous pair of currencies, the one that we just put the area, but for selling is the same condition. Until the price doesn't reach this area, we have nothing to do but to wait. That's it. Now we can do something is about moving the daily, because the daily, same than the other one, has changed already. And that might change, the zone. I have here some confluences that I put before, so let me explain that one here. Weekly and daily are bullish, yes. Narrow weekly and daily are of interest, yeah. This is it's not as narrow as the previous one that we saw, but still narrow. It's in a good area. EMA going up as well, so the exponential moving average is going up as well, which is another very good confluence. Sorry, it's not the same if we have this and the exponential moving average is going like this. You know, it's okay, we still can take the trade, but we're gonna have something against the confluences, and it's gonna be the exponential moving average. But in this case, it's positive. It's going on the same direction. The daily last structure point is that basically daily was coming here. Holy cow! Daily was coming here, 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 here. Now I start going like this. Then you break here, and boom! And the zone is where we are waiting to take the trade. And if you can see, this point is on the same point that this point, pretty much. The zone and this point, it's pretty much the last structure point. So it's another confluence. So it's a good area to buy or to sell, in this case to buy. That's basically what the last structure point means. It's the bounce of in the same area of the last point. So for example, let me just put a graphic version of this. So boom, 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 boom. This will be the last structure point, you know, because it's meeting this point here and it's meeting this point here. And from here, we hope that the market continues going up, okay? So that's the last structure point, is what's happening here. And if it's going down, it's basically the same, okay? If it's bullish, it's basically the same. If it's bearish, sorry. So that's another confluence, is something good. And psychological number on area of interest, which is very coincidental. I didn't put this on purpose. I just look for the zone. And when you check here, this number here is 161000. Basically, the psychological numbers, I don't want to explain it in a hard way, is the numbers that ends with 3 zeros. Basically is that. If it ends with 3 or 4 zeros, it's a very important point. It's some areas where people or institutions, sometimes they wait to sell or to buy. For example, if I have this one here, 63500, that's not a psychological number. It has only 2 zeros. This will be 1. This will be 1. This will be 1. This will be 1. But as you can see, the distance is very far. From here to here is very far. So it's very coincidental that the psychological number, it's exactly on the last structure point and on the zone, on the area of interest. If this price reach this area of interest and the conditions for buying are given, it's those kind of trades that you buy without hesitation, without fear, without panicking. You can do it. You can do it, and even if we lose money, let's say it's one of those cases that all the confluences are broken and the price do whatever they want, whatever it wants. If I lose this trade, I can sleep properly at night because I put my money on a high possibility trade, you know? I put the odds on my favor, and that's what it matters. I don't control the result. So what I'm going to stress about the result of the outcome of the trade? I don't control it. The only thing I can control it, I'm really aware and trying to, and that we have to make sure that we follow, is the risk management. As I say before, we only can lose 1% of the balance. So now that I move here, the daily bottom top, so you can see here, let's check how that changed. Daily is here, now is here. So what we're gonna do is to change this one here, because now the area is a little bit bigger. Oh wait, 10, and that's it. Okay, because the daily has keep going up, so this point is gonna change, of course. Let me just block this one, and I just put the one here. Okay, it means that is not the beginning of the area of interest, is not the psychological number anymore, but still inside in a very good position, as you can see here. Wait, let me show you. Coordinates, still in a very good position, you know. And also, if you can see here, that psychological number, it confluences with a rejection point, has a rejection point, then it breaks here, but once it comes back from the top, it has a rejection as well. Comes here, it breaks, once another rejection, it breaks up again, and hopefully when it comes back, it's going to create another rejection. That's waiting for the proper trade to take. That's trading with a plan. Okay, guys? So same than the previous pair of currencies. Until the price doesn't reach the area of interest, I'm not interested, so I just continue. Red, same problem, long distance. When it's selling, we need that the price is around this area. When it's buying, and we need that it's around this area. You already have the idea. Two colors, I don't care. Same color, but daily the weekly is on here. Daily is really low here. And wait, let me check something, the weekly. Oh yeah, no, look at that. Yeah, the weekly is here. Holy cow, no. We don't care, we are not interested about this one. Look, we were like that. We didn't see the last point of the weekly. I was looking for the weekly higher low, and look at that. We don't care about this. We are not interested. So next one. Okay, here I see something very interesting, because there is a blue line. There is a blue line that I use personally when it's break of a structure. Okay, I have to wait. I have to bring the previous conditions so we can continue with the same information. Wait, if I put... Oh, yeah, no, that's fine. That one's fine here. This is just for information. Oh my gosh, I'm still a little bit sick, guys. So sorry if I'm sneezing or coughing. Okay, so we were on these conditions. The price needs to be at the zone. As you can see here, after, you know what this square, blue square means already. So please, stand to the left, stand to the right. Okay. So you already know what's this square, and what happens is the price already reached the zone. I have a little blue line that it says 1 hour BOS. That's when we talk about the break of a structure. So once the price it's on the zone. So wait, this is not good grammatical. We wait for the price to reach the zone. Okay, now 7. Once the price reach the zone, which is this case, we wait for a BOS on lower time frames. In this case, the one I use is 1 hour. What is a BOS? Let me explain to you. So we already know that this is a bullish market. Yes. Basically, BOS stands for break of a structure. So what is a break of a structure? When the market change from bearish to bullish, or vice versa, or bullish to bearish. So if we have here that this is the price in this market structure, right? This will be higher high, and this will be higher low. Sorry, higher low. A break of a structure is when this price moves from here and end up here. So you see what's happening. We have a structure that is bullish, and suddenly it breaks here. Once it breaks below the higher low, of course everything I explained going up is the same going down. Okay, it's exactly the same. So just be logic. So if we have a bullish market and the price breaks below the higher low, automatically this point here becomes a lower low, because now it's lower than this low. So it's a lower low. And this one will become automatically a lower high, because most likely this is gonna come here and then continue going down. Okay, so this is a break of a structure. This is a break of a structure. When we have the breaking from, let me just put this one, this was the higher low. When the higher low, and this was the higher high. So it was the higher high, higher low, higher high. Once the price breaks below the higher low, this higher high disappear, and now it's a lower high, and this is the lower low. Okay, and this will be this disappear because we are not in a bullish market anymore. So that's my point. When we break, the price breaks below the higher low, and when it breaks above the lower high, there is a change of structure. So if that's the explanation of break of structure, and we are saying we wait for a break of structure on lower time frames, in this case 1 hour, what does it mean? So that's what we're gonna check. Probably in this I'm gonna be explaining the entry and everything. So we have here the time frame, weekly, 1 hour. We go to 1 hour. I like to do it with 1 hour. So look at this. What's the market structure in the 1 hour time frame? So we have boom, 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 boom. I'm gonna leave it till there by now because I want to explain something. So I have this one here, just three. I have this one here. Let me just put it. Can I bring it on front? Yeah, bring it on front. So I have this structure here. Yeah. So basically a little bit like this. Let me just open it wide so you can see better. We have that. Once the price reached the zone, which was on the top of this blue square, so it was on this bar. Yeah. This one was the bar that activate the alarm that says weekly, daily zone or weekly, daily area of interest. So when the price reached that area of interest, I have to identify what was the market structure at that point. So when I receive the alarm and I see, oh, it was activated, I need to identify what's the market structure, and it was bearish. So I can see here that it was bearish on this one and on this one. Yeah. Do you understand what I'm saying? Pam, 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 pam. Bearish, bearish. This was the lower high, this point here. And this was the lower low. As I told you, remember the same things that happen on the big time frames, on the bigger time frames, it happened on the lower time frames as well. So when this alarm was activated, because the price reached that area of interest, this was the lower high and this was the lower low. It means that if we are waiting for a break of a structure What does it mean based on what I explained before? It means that we need to wait that this price reach here and breaks above the lower high. Correct? Does it make sense? We are waiting for that. But what happened? The price continued going down. So we have this one here, boom, boom, and then continue going down. It means that the lower low now is this point, and the lower high now is this point. So now you might be understanding why I have a blue line in this point. Do you make sense? And you might wonder why I have the alarm of the 1 hour breaking of structure not on the blue line. I will explain you why. I put the alarm on the blue line. I always put the blue line. The blue line is the graphic indicator for me that we are waiting for that line to the price to break through the line. Either way, up or down, regardless, we are waiting that the price go through that line. So why I have the alarm a little bit above of the blue line? Because if you can see here, the alarm touched this area in here, but it didn't break it completely. It's not only enough that the price touched the alarm. It's not enough that the price activate the alarm. We need to look for a strong movement that it breaks this area powerful, something like this. Something like that. It's not enough that, look, in this case, the price touched the alarm, which is, the alarm was before here on the blue line, and then continue going down. So it's not really a breakthrough, it's not really a break of structure. I want you to really memorize that. Not because the alarm activate the line that it was put for the break of structure, it means that it's going to happen or is happening a break of structure. You have to wait that the candlestick that touched the alarm ends the complete formation. In this case, it's still 23 minutes for this bar to be completed. We need a bar that once it's completed, it breaks something like this. Something like that. Let me just put something like, wait. Something like this. Of course, we need a bar that really go across through the line of the last structure point, which is the lower high in this case. If this is the lower high, which is still the lower high, because it hasn't been violated in this case, remember, we don't take into account the tails, we care about the bodies of the candle to identify the market structure. So what we're waiting for to happen is that at some point this price go here, and boom, we are waiting literally for something like that. I have the alarm again, I put it again a little bit higher, because probably when it breaks here is because it's gonna break through. It's higher than the lower high. So probably when it breaks here is gonna be the real break of a structure. We don't have to get fooled by these candlesticks of rejection. They take the alarm and they remove it, and this is possible going down again. So if you take a trade of buying, but this is gonna continue selling, going short, you're gonna lose your money. That's very common to happen. Don't fall on those traps, okay? So what's the situation that we are aiming for? The situation that we are waiting is that this market breaks through here and then comes back here. And hopefully, when that happens, the EMA is gonna be also doing something like this. Remember, the EMA is not like the definite or like the ultimate confluence, but it gives you a lot of support. It gives you a good information about what's going on. When the prices is gonna start crossing, going through the EMA, it's a good sign, you know. When it start crossing, when the price is not below the EMA but now it's above, it's a beautiful sign that the market is doing a whole change of structure, a break of structure. So let's pretend all of this happened. This is probably the pair of currencies that it's more advanced from the ones that I look for the week. If I check on the login, yes, I only have one alarm active on 1 hour break of structure. And oh well, no, I have 1, 2 waiting for break of structure. But it takes time. As you can see, the alarm was touched long time ago and it still hasn't created a break of structure. We don't want to take any trade without following the plan. We have to follow this. Look, just read this square, these instructions, and you will be fine. So once the price do this, boom, what we're gonna do is to wait for the price to come back here to the blue line, which is the line where that line represents the break of structure point, the real point, not the alarm. The alarm is just for give us information to understand where, if there is a real break of structure or not. But it was the original one. That line is going to be our entry point. But after all of this happen, you know, look all the things that needs to happen before we take a trade. The entry is the last part. But basically on the line we're going to be taking the trade when it comes back. And the stop loss, we're going to put it below the lowest point. Now, you can put it below of this one, which is a lot, and it's still looking for a 2 to 1 risk radio rate. So if you put the stop loss a little bit below the lower point in this structure, and then we wait for the price to go up, if we check on the daily, we check on the daily, it will make sense. Look, if we check on the daily, the price will be doing this. Pam, 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 and hopefully it's gonna reach the next the daily higher high. But we are not gonna be greedy. We are only gonna be looking for a 222. You know, 122. Sorry. So what's gonna happen? What's gonna happen is that, okay, let's delete this one just to avoid the mess in the charts. Let's delete this one as well. So I don't know if that's clear. I hope it's a little bit clear for you. The entries, we always look for the entries on the 1 hour time frame. The stop loss, we always put it below the lowest point that we have, a little bit below. Why? Because if it takes our stop loss, let's pretend this break here, it came here, goes like this, and maybe boom, start going down. We want to make sure that if it takes our stop loss is because we were completely wrong. And that's fine. That's fine. We can be completely wrong, and we will. But we want to make sure that it has to be that scenario in order to lose money. You know? So basically we are waiting for the market to move from bearish to bullish on the 1 hour. We already know that the weekly is bullish. We already know that the daily is bullish. Basically we are just waiting for the perfect entry. That's it. That's how you take the trades like a professional, you know, having a plan like this. And another, I'm gonna give you a little bit of information ahead. Once we take the trade, let's pretend that we already are inside of this trade. Once we take the trade, the only thing that we do is to check the half, the 1-to-1. Let's delete this one just to avoid confusion. So this is the entry point where the blue line is. This is the take profit. This is the stop loss. And this is the point where we reach a 1-to-1 risk ratio. Okay, this will be the 1-to-1 risk ratio. 1-to-1. And when we have 1-to-1, so the price do something like this. Tin, 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 tin. When the price reach the 1-to-1 area, we simply move our stop loss to the same entry point. So that's going break even. Which means that only two results can happen from that point. Either we win 2% of the account, in this case $200 because it's a $10,000. So either we win $200 or we lose nothing. We lose nothing because the price is gonna either get back here, which is the entry point, we don't lose, we don't win, or it's gonna go up here. Either one or the other, but we don't lose money anymore. I mean, we pay commissions, of course, we have to pay commissions, so probably we're gonna lose $1, $2. So it's not gonna be zero, it's gonna be maybe $1 or $2. But for the exercise, just to make sure you understand what I'm saying, is basically winning 2% of the count or losing none. Okay? So guys, this is pretty much the whole explanation of how we're gonna pass the challenge. This took me years to understand this. Took me years, and I'm sure that you won't get this straight away because it's not only about the theory, you need a lot of practice. But I want to make this challenge with you at the same time, so I'm explaining you what's the plan. That's the plan to pass the challenge. Next pair of currencies, I don't care, different color. This one, different color. Oh wait, I'm in 1 hour. Let me go to daily. Yeah, different color, I don't care. Same color, not good position because it's selling. This should be the perfect position around here. And as you can see, it did it. It reached this position and boom. Look. Look. This is the zone on the weekly. The daily was here, pam, 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 pam. When it reached this area, boom. Okay, so this already happened. So basically, look, if we go backwards, this is the point where it touched the area of interest. If we go to the 1 hour, we can find that spot and to see what happened in order to take that trade. You have to wait for the confluences to happen. Look, this was the point. Wait, let me get back to daily just to have a line, a proper line. Look, if I have the weekly, I'm gonna create the line here. Just put it here. That's gonna be the weekly zone. So let's get back to 1 hour. And if you check here, look guys, let's see how would have been the outcome of this one. Okay, we already know this is the area. This is the zone. So when it touch here, we need to identify the point of structure. So in that case, this would have been, let's change this to just for this exercise, let's change it to it's going now. No, let's leave it yellow. Let's leave it yellow. That's the zone. Sorry guys. So basically when it touched this area, what is this? I got lost. 4 hours. Oh, it was here. It was here. 1 hour. What's the circle? Damn. Oh yeah, it's here. We are here. We are here. So the first point to reach that area was here. Not here, this one. So basically this was with the, it was green, so the high. This was the higher high as well. Touch the point, market structure, go down. It reached the point here. Look at this, guys. There's some how you call it, patterns that you need to memorize, and this is one. For example, this is a double shoulder. So when it gets here and it breaks, this is basically, let me just put the break of structure point. This is basically the line that needs to be break. Okay, this is the break of structure. So once it breaks, this is the real breaking through. This is the kind of breaking that we're looking for, not the small ones. Remember, don't get full, but align. The break of structure should be a big movement. Okay, so we know that on this break of structure, look, rejection, go through. This is the point, the blue line is the break of structure, and this is a real break of structure, not this one. Don't get fooled with these ones, guys, please. This is just an average movement, plus the price didn't go through the exponential moving average. If you can see here, at this point, the exponential moving average was still very steep up, going up. This barely touched the breaking of a structure point and then continue up. But in here, in this movement here, that it breaks, when it breaks on here, when it breaks on here, you can see that the exponential moving average is going sideways, getting ready to going down. That's the kind of confluence that you want to, that you will know that is the real breakthrough or not, that is breaking of a structure. So if this is the real break of a structure, what will be our entry? Our entry will be on this one. The highest point is this one, so we go up a little bit. Yep, and we only look for 1 to 2 here. So if the price is here, when the price breaks through, we set our entry point, which will be here, and we only need to wait for the price to reach that point. So it was here, look, it reached back that point here. So this is the real entry. This is the real entry, and look the outcome of that trade. That's the outcome. Remember, the exponential moving average talks to you as well. If there is a line, this is the, let's say this is the break of a structure, and the price needs to go through from the top to the bottom there, but if you have the exponential moving average like this, very steep, it's difficult. Normally on a breakthrough, on a real break of structure, the exponential moving average should look something like this. Oh shit. Should be looking something like this, like start going sideways. Okay? So when the price breaks, it's breaking through the exponential moving average as well, and when it comes back, the whole price and the exponential moving average is going down as well. So you can clearly see that there is a change of structure. You don't want to have doubts. If this breaks the lines, remember the break of a structure is not that it touched the alarm, it activated the alarm, or it touched the blue line. It has to break with power. Look, this is power. This is breaking with power. Boom. This is not breaking with power. This is just a fake movement to continue on the upside. Okay? Nevertheless, let's say that you took it, that you thought this was the real break of a structure. Even like that, you would have made money. Why? Because the entry point would have been here, but the stop loss would have been a little bit above of the highest point, and this goes 1 to 2. Oh, wait, 1 to 2 would have been pretty much the same point than this one. So it would have been a longer trade, but at the end of the day, you would have made money as well. It's really important, the stop loss location. The stop loss needs to be above the highest point and below the lowest point, because you want to make sure that if you are wrong completely. And we only go for 1 to 2 because look, if we are greedy and this continue, let's say that we want a lower, more profit. We put this below, we still don't reach we don't reach the take profit, but it goes back and boom, it takes our stop loss. But we already were making, this was a 3 to 3, we already were making a 2.27 and we didn't take any money because we were greedy. That's why we do the 1 to 2 risk ratio and to take the profit, because we want to make sure that that we can guarantee or put the odds on our favor in order to take the profits. So now you understand, even though these two are on bearish, the ideal area will be here on the yellow, which is this one, not in there. So the two zones are very separate. I don't care about those two. Same with this one, very separate. Same with this one, very separate. Different market structure. This one was a special case. Why? Because this one actually shared a good area together. It was one here. It was one here. So the area of interest was here. But what happened is that on Sunday, when I was checking the market structure on every pair, the price was already crossing the zone. So it was going through the zone with so much power that it's hard to think that it's going to make a comeback. It's basically making a change of structure. If you just check here, this is the daily lower high, daily lower low, but now this has already go through above the daily lower high. So yeah, there is a change of structure. I have to change that. So this one actually becomes now, this one here, it turns green and it's gonna be called daily higher high. And the last, the lowest, the daily higher low will be the last lower point, which in this case will be pretty much the same one. It's basically this one. That's it, and it turned green. So just because that movement in one day, you see we have an arrow state, but because there was never a break of structure on the 1 hour, we avoid losing money because there was never an entry point. And now they are different colors, so I completely don't care about this one. Okay, this one, same than the previous ones, really nice setup, but nothing will happen until you reach the weekly daily area of interest or the zone, whether you want to name it one way or the other. It's a beautiful setup. Same with this one, with the one that when I was checking on the market structure, it was already crossing above the zone, and look, clearly this one already break up above this one, so this one is as well changing. Now it's here, now it's green, and now it's a higher high, daily higher high. Let's save this one, and in this one the lower low, it changed a lot because now it's gonna be to the lowest point of the market structure. Now it's gonna green, and now it's gonna be daily higher low. Does it make sense what I'm doing here, guys? Because there was a break of structure on the daily, so it means that the weekly and the daily are not synchronized anymore. So yeah, I don't care about this one anymore. I have the zone, but there was never a break of structure on the 1 hour. That's how important is the break of structure. As you can see, the entry point is the last thing, and this one we are waiting for a break of structure. It's in a perfect zone, but if this break of structure doesn't happen, look, if it doesn't break below this point, yeah, which is a very strategic point, it has a lot of rejection from previous days, it has to break. It's gonna happen one of the other. It's gonna continue like this and create a change of structure on the daily and on the weekly, or what it's gonna do is that it's gonna go like this, and at some point it's gonna break strong and then come back, and then we can sell. And hopefully when it breaks strong, this is gonna be doing like this. Okay, so the price have to go through the exponential moving average. I didn't put it as a confluence because there's some exceptions, but look, if you want a beautiful entry, make sure there is a break of a structure. It breaks your last structure point, but also that goes through the exponential moving average. And I can guarantee you're gonna sleep very well at night, because you're gonna take trades, really high probability trades. You're gonna put the odds on your favor basically, and still you can lose, of course. As I say before, there's not such a thing like 100% guarantee strategy, but you're gonna be taking very good trades that over time they're gonna pay off. So yeah, we're waiting on that one. This same, the zone is too big, so I don't care. Zone is too big. The ideal, it was on this area here below. Sorry, no, it's actually very good. Wait, because it's selling, so we want to start selling from here. Oh yeah, I didn't like here on this one that the daily was changing a lot. This market structure on the daily was very bullish, bearish, bullish, bearish, bullish, bearish, bullish, bearish, bullish, bearish. So basically what that means is in an accumulation zone, accumulation area. So this powerful area is accumulating power, and it's gonna do one or the other. It's gonna do this, break really strong up, or it's gonna break really strong below. If it breaks below, we just wait for the price to make a comeback, and then we look for the entry on the 1 hour, not a problem. But yeah, I didn't put that on my options, because even though the location is good comparing to the zones on the daily and on the weekly, When this accumulation happens, if we go to the 1 hour time frame, there's gonna be a lot of break of structures all the time, but not really powerful ones, because it's just going up, going down, going up, going down, going up, going down. So I'd rather wait for this accumulation to break. If it goes up, it wasn't my trade, I didn't put any money, so I saved myself from losing a trade. If it goes down, which is the idea that it goes down, I wait for the price to come back, and then on that comeback I identify the zone, and then we do everything the same with the 1 hour, and hopefully going down. But not like that. These kind of exceptions, I can do it, or I can do this kind of exceptions because I have seen this scenario so many times, and it has taken my money for so long, so many times before, that already when I see that, I prefer to let the market do its thing, so to give you a direction, you know. I don't want to guess the direction. In this case, is not really clear, the direction on the daily, because it's pretty much sideways. That's the explanation. The market is moving sideways pretty much on the daily. I don't like that. I like when the movement is clear. On the weekly, on the daily, both are selling, both are buying, but this one is sideways, so it's kind of, where are you going? You know, it's like, I have this one, then I have this one, powerful movement up, powerful movement down, and then sideways. There is like no clear scenario for taking a decision. It can easily break through here, or it can easily break through up there. I want to wait for the market to give me the instructions, to give me the direction. Remember, don't guess. Let the market give you the information. So, and we are back to the very first one where we start this video, which is the Australian dollar, Canadian dollar. Remember, we have the instructions here. This is the plan. This is the general information about the everything I show you, and this basically is this information. Okay. So look, guys, what we have here. So just to finish this live, I hope if you see this in the future, you understand the plan. So FTMO challenge, 2 phases. Phase 1, we have to make 10%. Conditions, we can lose more than 5% per day, and we can lose more than 10% of the count. Phase 2, we have to make 5% on profit, and we can lose the same conditions. We can lose more than 5% per day. We can lose more than 10% on the account. We're not going to lose more than 1% in any trade from original capital. As I told you, if we have some positive trades, we might raise the risk, but the risk will be raised always based on profits that we already made, not on the original capital. We will be looking for a 2-to-1 ratio always. We don't want to be greedy. We want to stick to one plan, and that's it. With a 2-to-1, you are more than you can make a living of this. It's enough, you know. It's like we have to follow the plan to open any trade. What's the plan? Basically this one. So we have to identify weekly and daily area are synchronized, identify the zone each time, draw an area mixing both zones, weekly and daily. If the distance between both zones is huge, we forgot about that pair of currencies, at least for that week. During that week, if the distance is not huge, but it is a narrow area, we want to keep an eye on the pair, on that pair. The price needs to be at the zone. Okay, let's finish writing the rest. Pretty sure I write it on the other one, but it's okay. Once the price needs to be at the zone, we wait for a break of structure in lower time frame. In this case, it will be the 1 hour. Once there is a break of structure, once we have a clear break of structure, and the price is breaking through the exponential moving average. Well, once we have a let's put it one by one. 9, break of structure ideally should be breaking through the EMA, and 10, if those conditions are happening, entry point on the blue line, which is the break of structure line. 11, stop loss above the higher point if buying, or below the lower point if selling. 12, we look, take profit point always in a 2.1 risk radio. And 13, once we reach 1-to-1 profit, we move the stop loss to break even. And the last and most important thing, do nothing else. Just hashtag follow the plan. That's it. Once we get all of this, you just cross arms and do absolutely nothing. You don't want to be putting your hands on the trade. If you already have all these conditions on the plan and we lose, that's fine. But look how many things we are waiting to happen in order to put a penny on the market. This is a plan, guys. This thing here, I'm not kidding. This thing here is expensive as fuck because it's a clear plan. And what I mean expensive is not only money. I'm talking about time. I'm talking about frustration. I'm talking about dedication. I'm talking about not giving up on your journey. To have something that clear on your mind is because you have failed so much, you have made so many mistakes, and over time, when you try and you continue trying, you realize what works and what doesn't work. At the end of the day, this kind of plan is basically the understanding of a proper market structure. What is a market structure? What is a bullish market? What is a bearish market? And what is a break of a structure? Because if you understand that on the higher time frames, you're going to understand that on the lower time frames. You just need to understand higher time frames gives you direction, lower time frames gives you entry points. Okay? So guys, that's why this is not about the amount of trades we take, but the quality of the trades we take. I hope you have enjoyed this. It was a long live stream, I know, the very first one I do on this channel, but I really hope you have learned a lot, because basically I give you everything on this video. I give you everything. And I did that in order that you understand the kind of trades that we're gonna take. I'm gonna be sharing everything. I hope I don't have any problem on recording and, you know, when I'm taking a trade on recording and everything. But I'm gonna show you everything, the trades, stop loss, take profit. If we lose, we lose. If we win, we win. Number one thing on the psychological side is you have to be fine about losing and you have to be okay about winning. If you are still getting upset when you lose, or you are still getting so excited when you win a trade, probably you are still a naive or novice, sorry, naive is not the word, novice trader. Because you have to reach the point where this becomes boring. When this doesn't create any big emotions on your heart, it doesn't make you sweat, it doesn't make you nervous, it doesn't make you angry, it doesn't make you... It's an opinion, it's not a fact. It's just that once you understand this and you do it for a long time and you repeat it over and over again, you're fine with losing and you're fine with winning, and you understand it's just one trade and it's just a normal trade, it's one more trade. And when you understand and you remove that ego on your head, like, oh, I win two or three trades in a row, making a lot of money, and you remove that ego, that you understand, well, I do nothing to make the money. The only work or the only duty I have is that when I lose properly. But I do nothing to make the money when we win a trade. The only thing I do is to make sure I have a clear entry point and especially a clear stop loss point. If the price reach the take profit point, is not because I'm talented. It's not because we are talented or we have a skill. The only skill that we have on this thing is to lose properly, is to lose according to your account, is to lose like a professional, and is to lose based on this shit. Sorry. On this thing is losing according to the plan. Saying no more, guys. I hope you have enjoyed this live stream. The idea is to grow this channel together. The idea is to start sharing my experience. The idea is to help as many people as possible. And I think this is great platforms to do it, like YouTube or Instagram or something like that. I'm just starting on this project just because I want to spread the word, and I don't have to learn anything else because I have a clear plan on my mind. You know, if I lose, I lose. If I win, I win. But the important thing is that I have a clear idea on the plan. So that's it for today, guys. Remember to follow, to subscribe, maybe share the video. You find me on Instagram with the same, becoming a FX trader. And yeah, if you like this content, just interact with it. If you have questions, comments, whatever, just let me know. The idea is to help each other as a community, and of course to help as many people to start passing their FTMO challenges or Profim challenges, whatever it is. Yeah, that's it for today, guys. Thank you for watching this video, becoming a Forex trader. And remember, hashtag follow the plan. That's our motto. That's our motto. Hashtag follow the plan. That's it. Remember that one. So thank you, guys. Hope you have enjoyed. I will be in touch with you guys during the week just to show you if I take any trades or not. It's possible that never happens. As you can see, all these criteria, all these conditions have to happen in order to put my money. So that's it. Thank you, guys. See you next time.